Today's program may be recorded. It is now my pleasure to turn the program over to your host, Lee McEntire.
Good morning. Welcome and thank you for joining the call to review the third quarter results. I trust everybody's had a chance to review our earnings release documents. As usual, they're available, including the earnings presentation that we'll be referring to during the call, on the Investor Relations section of the bankofamerica.com website. I'm going to first turn the call over to the CEO, Brian Moynihan, for some opening comments, and then ask Paul Donofrio, our CFO, to cover some other elements. Before I turn the call over to Brian and Paul, let me just remind you we may make forward-looking statements and refer to non-GAAP financial measures during the call, just regarding various elements of our financials. Our forward-looking statements are based on management's current expectations and assumptions, and they're subject to risk and uncertainties, particularly as we continue to operate in this pandemic period. Factors that may cause those results to materially differ from expectations are detailed in our earnings materials and the SEC filings that are available on the website. Information about our non-GAAP financial measures, including reconciliations to U.S. GAAP, can also be found in our earnings materials available on the website. So with that, take it away, Brian.
Thank you, Lee, and thank all of you for joining, and I hope all of you are staying safe. We're going to begin on slide 2, and today, before Paul takes you through the detail on the financials, I thought I'd give you some thoughts on the first 3 quarters of 2020 and how we're driving for you here at Bank of America. As an opening comment, the economy and the markets this year have been defined more than anything else by the impact of the global healthcare crisis. This has created a sinuous path for the recovery. As we have said early on here at Bank of America, and what our data continues to suggest, is that we are seeing a return to the fundamentals of a generally sound underlying economy, but we won't get there until we fully address the healthcare crisis and its associated effects. These effects have been lessened by the monetary and fiscal policies and by the core health of the U.S. consumer, given those policies. There are 3 key themes that I'd like to comment on. One is the economy generally, what we see in our data, and the impact of the projected path on the economy's earnings and the company's earnings and prospects going forward. The second is how do we continue to think about and manage the risk resulting from the economic downturn and the subsequent beginnings of the recovery. And the third is how we are making progress, given all that backdrop, on our corporate strategies. Before I touch on these items, just a brief summary of the quarter. Overall, solid performance given the operating backdrop we face. We earned around $5 billion after tax, or 51 cents per share. We ended the quarter with a capital ratio of 11.9% versus 9.5% minimum. For the third period of this pandemic, we've earned more than twice our dividends, attesting to the strong balance sheet and security of this company. The operating environment continues to require more operational excellence than ever before. It requires delivery of immediate technology capabilities across our franchise from our group of talented teammates. It also has to deliver a customer experience that can be redefined on a daily basis. It also has to meet customer demands, which ebb and flow given the daily events. It has required extra costs to do the right thing to protect our teammates, our clients, and our franchise, all while processing higher transaction levels and dealing with volatility and the high volumes that come from it. It required operose work on delivery on a day-to-day basis. This results in expense that remains elevated this quarter as expenses from COVID. However, our disciplined expense management remains well intact. We have turned the corner on these COVID costs. As we see forward in the fourth quarter, we see the costs coming back down the company. That is evidenced by the drop this quarter of 3,000 in our head count on a quarter-to-quarter basis. And Paul will talk more about the path going forward in a minute. So let's start with the economy and its impact on our company. We saw another partial restoration of the U.S. economy. We saw that in our outside data, and we saw it in the large base of spending on our customers. As you think through the quarters, in the first quarter, our customer spending was impacted as we hit March after a strong start to the year. However, for the quarter, our customers still spent more than they did in the first quarter of 2019. The second quarter saw the worst of the crisis in terms of spending. It was a 30% drop in GDP, and the spending fell deeply in April, but started to recover as stimulus, PPP, and other monetary policy kicked in May and June. And also, the reopenings began. In the third quarter, we've seen a full restoration of spending by Bank of America customers when compared to last year. Overall, the customer payment levels in September 2020 were larger than September 2019. Year-to-date, across $2.3 trillion in spending at Bank of America, customers have spent more than they did last year. You can see that in slide 26 in the appendix. This has occurred even as some of the summer 2020 stimulus programs have run their course. Our own Bank of America economic experts predict a sharp rebound in third quarter GDP of around 30%. So simply put, we're back to 90% plus where we were in terms of GDP size. So what are we seeing as we've turned in October? The spending by our consumers is still solid, about 10% ahead of last year. Deposits remain elevated and continue to grow in consumer banking and global wealth management. In global banking, deposits are flattish as customers continue to make choices about the liquidity. We are seeing loan demand stabilize, and we may have seen a trough in September. And commercial utilization rates have come down below pre-pandemic levels last year. As the economy continues to grind forward, we believe we'll see some demand recover over the next few quarters. In consumer lending, card balances appear to be stabilizing, credit spending continues to grow, and we are growing at new accounts in our consumer card businesses. New accounts are growing in our auto lending business, and our mortgage business is stable. So this view of loan demand and more stability of balances, the ability to redeploy some of the cash balances given the now lengthier stability of customer deposits, leads us to believe that the third quarter was a trough quarter for NII, and Paul will cover more of that later. The second topic I want to touch about is going to slide 3 on the risks. We continue to remain focused on all the risks, whether market and trading risk, credit, operational, reputational risks, given the incredible volumes and unusual working conditions that we're all in. Going back to the first quarter volatility, the concern was obviously market risk. We've handled this market risk well. And again, for this quarter, the team made trading profits on every single day. Our capital levels and liquidity are historically high levels, as I stated before, and liquidity stands at over $860 billion. Credit risk is the current focus in this quarter, and you can see the highlights of that on slide 3. Charge-offs declined for the quarter. Reserve build this quarter was on the commercial side. Mostly that's due to the specified industries that are facing still not being fully open and the length of time it may be till they reopen. Consumer card release reserves, for example. We believe we are staying ahead of the commercial risk by aggressively reviewing our portfolios. Over the last 2 quarters, in each quarter, we've done a 100% review of all the middle market and business banking portfolios to ensure we have strong internal ratings integrity and focus on the ability to pay as well as just having liquidity. You can see an increase in the criticized exposure that comes through those views and re-ratings, but is more focused on the certain industries, and Paul will touch on that. In the first couple of weeks, we've seen the criticized assets come back down on some of those clients that refinanced. Meanwhile, overall, non-performing loans remain around $4.5 billion, with commercial basically flat to the last quarter and consumer growing around $200 million. Overall, the balance of non-performing loans remains at a modest 48 basis points to loans. This is a testimony to the decade of responsible growth this company is engaged in. Importantly, the deferral story, which we talked about the last couple of quarters, is largely over. We only have 100,000 customers remaining on deferral at the end of September. Of the $9 billion in total consumer balances that remain on deferral, $7.5 billion are mortgage loans. Those are well secured and low loan to value, and among many other positive attributes, including 25 to 30% of them are in the wealth management business. All are accounted for in our reserves based on the expected losses that might come. Interestingly, both card delinquencies and mortgage delinquencies are down in terms of dollar amount and percent year over year. Having said all this around credit, we don't expect to see a meaningful increase in net charge-offs till mid-next year, and we expect that the reserve builds are behind us, which means the P&L impact of those losses should be in our financials already. So then the question becomes, after managing the risk, is have we been investing in the company at the same time? And that you can see as you move to slide 4. Through our continued investments in technology, we continue to improve our platforms across the board, drive operational excellence, invest in the future, all while growing core customer and client households throughout the quarter. In our commercial businesses, We're now actively prospect again, having done the reviews I spoke about early, fully assessing the credit quality of existing clients, and then focusing our production work on the prospects we know we can get around the country. In our consumer businesses, we continue to grow net core checking households by about 900,000 year over year, and $100 billion plus in checking balances. We saw strong growth in Merrill Edge in our consumer customer investment platform by $40 billion in assets year over year. We've seen depth and penetration and digital engagement across the whole consumer business. In our wealth management business, even as our advisors work from home, our private bankers and financial advisors grew households again this quarter. In fact, we reached a record new client balances of $3 trillion. We also continue our investments in our market expansion during the crisis. We added 13 new financial centers in the quarter and continued to offset that number with closures that were pre-planned before the pandemic. But the key area we continue to change the company is in the digital capabilities, not only in consumer but across the board in every business. This digital enablement is a trifecta of better customer engagement and client delight, deeper penetration of products and services, and operating efficiency. And with the rollout of a new industry feature like this week's Life Plan announcement, where we now have 500,000 customers have already filled out a Life Plan financial plan over the last couple of weeks. You can see these digital engagement highlights on slide 4. This quarter, we had 2.3 billion in total digital logins in our consumer business. Erica is up to 16 million users. Zelle is at 12 million users. Importantly, you see at the bottom of the list the digital engagement of our wealth management customers. Through that digital platform, Merrill Lynch and a private bank are again proving that we're high touch and high tech. This ranges from how we provide advice and personal research to how our clients have interacted with us to do things like just deposit checks. And that was up dramatically over the quarter as our advisor and clients embraced our new digital capabilities. In the middle of the page, you see the statistics for our commercial business, for our products called Cash Pro and Cash Pro Mobile. This makes our clients' lives easier and saves them operating costs. And here in the Cash Pro area, we've rolled out a bunch of new features and user interfaces and capabilities last week to allow companies and company treasurers to better manage their money around the world in all kinds of currencies and all kinds of environments. So in summary, $5 billion in after-tax earnings and a solid quarter. Progress on the economic recovery, progress on the risk, but most importantly, underlying that business, strong growth in the business side and the customer side of the business, which is what we do, and we'll continue to do it in perpetuity. With that, let me turn it over to Paul.
Thanks, Brian. I'm starting on slide 5 and 6 together. In most periods, my earnings remarks are focused on year-over-year comparisons, but this quarter, many of my comments will be directed towards comparisons against Q2 20, as most investors we speak with are more interested in our progress quarter-over-quarter as we work sequentially through the health crisis, and given COVID has made year-over-year comparisons less relevant. Q3 net income of $4.9 billion, or 51 cents per share, compares to $3.5 billion, or 37 cents in Q2. The earnings improvement was driven by lower provision expense as we modestly added to the reserves for credit losses in Q3 compared to the more significant increase in reserves in Q2. Versus Q2, the lower provision expense was mostly offset by lower NII and higher costs of litigation and costs of the COVID environment. Lower rates and loan balances caused NII compression, which I will discuss in a moment. The linked quarter decline in non-interest income was driven by the more robust trading and IB environment in Q2, as well as a $700 million gain on the sale of mortgages recorded in Q2. While down linked quarter, fees from capital markets in both market making and investment banking were solidly up year over year. At $1.8 billion, investment banking fees were the second best quarter in the company's history. Brian noted progress in activities levels across many of our businesses, and that showed up in increased levels of fees, which helped to mitigate the linked quarter decline in capital markets revenue. Q3 saw card income and service charges move higher from the more heavily impacted Q2 levels. We also experienced higher asset management fees as the market improved, and we grew net new households again this quarter. Turning to expenses, they were higher in Q3 than Q2, driven by three things. First, we built litigation reserves for litigation with respect to some older matters. Second, we had an increase in COVID-related costs. And third, this is the first quarter in which we recorded merchant servicing expense. It is important to point out that the increase from recording merchant servicing expense and even some of the increase in COVID-related costs were associated with increases in reported revenue, which obviously helps defray their impact on profits. And with respect to the linked quarter change in pre-tax, pre-provision income, I would also point out that the $1.3 billion of the decline was driven by two more abnormal items. The prior period loan sale gain of $700 million and this quarter's elevated litigation expense of about $600 million. In addition, given a reversal in UK tax policy, our results included a $700 million positive adjustment to our tax expense as we revalued our UK deferred tax asset that had been previously written down. Our ROTCE was 10% and ROA was 71 basis points. Moving to the balance sheet in slide 7, we ended the quarter little changed from Q2 at $2.7 trillion in total assets. The main point I want to make about the balance sheet is the redeployment of some of our excess liquidity out of cash and reverse repo and into securities. Cash and reverse repo declined by about $112 billion from Q2, while security levels rose by a similar amount. This will help offset NII compression from lower reinvestment rates in coming quarters. The only other notable point on the balance sheet was the decline in loans driven by customer paydowns. Shareholders' equities increased $3.2 billion as earnings were more than twice the amount of dividends paid. With respect to regulatory ratios, importantly, this quarter we received approval of our updated model to calculate operational risk RWA, which resulted in a $128 billion reduction in our advanced RWA. A decline in loans drove RWA even lower under the advanced approach. The improvement in RWA and capital improved our CET1 ratio under advanced from 11.4 to 12.7. The decline in loans improved RWA under standardized as well, but given the larger decline in our CET ratio under the advanced approach, standardized became our governing approach again this quarter. Our CET1 ratio under the standardized approach improved to 11.9%, which is 240 basis points above our minimum requirement and translates into a $35 billion capital cushion above that requirement. Our TLAC ratios also increased and remain comfortably above our requirements. Before leaving the balance sheet, I want to point out a couple of things with respect to loan and deposit trends. The charts on slide 8 and 9 show a 5-year trend as we wanted to give you a longer perspective on the growth of loans and deposits that incorporated more normal environments given the near-term disruption caused by the pandemic. Overall, year over year, total loans grew 1%, and in the lines of business grew 3%. Commercial loans rose $67 billion in Q1 and then declined in each of the next 2 quarters. Year over year, average global banking loans are only down 1%. In consumer banking, loans grew 5% year over year as the decline in higher yielding card loans was more than offset by the addition of PPP loans and residential mortgages. In terms of the path forward, a few perspectives. First, our middle market utilization rate a year ago was 41% and has now declined to 37%. Business banking has gone from 39% to 33%. We believe these rates are bottoming and should begin to move higher over the next few quarters if the economy continues to grind forward. With respect to credit cards, spending and cash volumes declined materially during the first half of the year, driving balances lower. The good news is that credit card spending continued to gradually improve in Q3, but remained significantly below pre-pandemic levels in certain categories such as travel and entertainment. Outside of PPP loans, where government forgiveness will drive declines, we remain optimistic that the larger loan declines of the past couple of quarters are behind us, absent a resurgence in COVID cases further impacting the economy. On slide 9, we provide the same trends by line of business for deposits. Brian already made a number of points on deposits, and you can see the tremendous year-over-year growth in every line of business. I will just add that in each line of business, rate paid on deposits is at or below the rate paid to customers in 2015 before the Fed began raising rates. So we think our strong deposit growth reflects our customers' overall experience with us. Turning to slide 10 and net interest income. On a GAAP non-FTE basis, NII in Q3 was $10.1 billion, $10.24 billion on an FTE basis. Net interest income declined $719 million from Q2 20 and $2.1 billion from Q3 19. The drop from Q2 was driven by lower loan balances and decline in interest rates across the yield curve, which was more pronounced on an average basis than on a spot basis. Given the decline in mortgage rates during the quarter, we saw an extraordinary level of mortgage prepayments. This resulted in higher bond premium write-offs and drove a little more than half of the decline in NII for Q2. Compared to Q2, the increase in prepayments was negatively impacted the yield on our securities by 30 basis points and the overall net yield on the company by 6 basis points. The lower long-term rates also continue to impact the reinvestment of maturing securities, lowering our NII and yield. The other primary driver of the linked quarter decline in NII was the lower commercial and credit card balances previously noted. While lower short-end rates did reduce the costs of both deposits and long-term debt, this funding off decline was mitigated by yields on variable rate loans, also repricing lower. We also want to point out that we saw a modest benefit in Q3 from the redeployment of some of our excess liquidity into securities. This should aid NII more in subsequent quarters. Given the sharp decline in NII, the net interest yield declined by 15 basis points from Q2. On the bottom right, we show the drivers of this net interest yield decline. I already noted the bond premium impact, and you can see the other drivers on the chart. In terms of forward NII guidance, there are a couple of caveats worth emphasizing, such as rates not moving lower than Q3 levels and the economy not taking a big step backwards from negative COVID developments, which could drive loan demand lower again. Having said that, we believe Q3 will likely be the bottom for NII, and we are optimistic it will move higher in 2021. Let me provide a few thoughts on why we feel good about NII moving forward. First, commercial loan utilization rates are at historically low levels, and with the economy expected to slowly grind forward, we are optimistic that over the next quarter or two, you could see C&I loan demand start picking up. As Brian noted, we are also seeing spending on credit cards slowly picking up. So, with stable customer repayment rates, we could see a seasonal lift in card balances as well. At the very least, we are not expecting the continued large declines seen over the past 2 quarters in outstanding commercial or card loans. In addition, some combination of refinancing fatigue and stabilization of long end rates should result in less bond premium write-offs than currently impacting NII. And lastly, as I mentioned, the deployment of cash to higher yielding securities will aid NII in the future. We believe these factors, taken together in the near term, will mitigate the ongoing negative effects of NII on higher yielding assets maturing or paying off and being replaced with lower yielding ones. Turning to slide 11 and expenses. Expenses this quarter were $14.4 billion, which are $1 billion higher than Q2. First, about $600 million of the increase is from elevated litigation expense. The remaining increase is split between higher COVID costs and merchant processing expenses, which are not higher, but just accounted for differently this quarter following the JV dissolution. The elevation in our net COVID expense was driven by costs associated with processing unprecedented levels of claims for unemployment insurance through our commercial card product and continued costs of supporting PPP loans. Both of these activities have revenue benefits which helped offset some of the costs. With respect to expense in Q4, we don't expect to have a similar amount of litigation expense, and we don't expect a repeat of the Q3 activity with respect to processing unemployment insurance claims. Therefore, we believe, absent other unexpected changes, our Q4 expense number should be in the neighborhood of around $13.7 billion. Turning to asset quality on slide 12. Our total net charge-offs this quarter were $972 million, or 40 basis points of average loans. While net charge-offs benefit from government stimulus and loan deferral programs, it also reflected years of adherence to our responsible growth model. The $174 million decline in net charge-offs was driven by lower credit card losses. The loss rate on credit card declined to 249 basis points of average loans. Provision expense of $1.4 billion, driven by a $417 million net reserve build this quarter. While total reserves grew modestly from Q2, total loan balances declined $44 billion, increasing our allowance as a percentage of loans to leases to 2.1%. I would also note the coverage ratio for every loan category increased from Q2, with credit card now just north of 11%, total commercial loans at 1.8%, and CRE at 3.7%. In terms of the process and key variables with respect to setting our reserve, which is something everyone seems to have great interest in, we continue to include a multiple of downside scenarios. The weighting of these scenarios produced an outlook that GDP could return to its 4Q19 level sometime in late 2022. The weighting also produced an unemployment assumption of nearly 9% as we exit Q4 20 and 7% a year later. So our unemployment assumptions for the end of 2020 is higher than the current unemployment, and the time to return to positive GDP improved compared to last quarter. At the end of the day, we built commercial reserves for exposures to industries more heavily impacted by COVID and left reserve coverage in other areas nearly unchanged, as we felt, despite the macro improvement, there is still too much uncertainty around unemployment, expiration of stimulus, the duration of the pandemic to reduce total reserves. On slide 13, we break out credit quality metrics for both our consumer and commercial portfolios. On the consumer front, COVID effects on asset quality continued to remain benign. Consumer net charge-offs declined $170 million, driven by a decline in card losses. 30-day delinquencies and NPLs rose from very low levels as deferrals ended and began to enter those metrics. As Brian noted, consumer deferrals have materially declined, with only $9 billion remaining, which are mostly consumer real estate related and have strong collateral values. Credit card deferrals have declined from more than $7 billion at the end of Q2 to around $400 million now, and more than 80% of the accounts with deferrals that have expired have made their first payment. Commercial net charge-offs were flat with Q2, but included higher commercial real estate losses, primarily related to mall exposures, which were offset by lower C&I related losses. Overall, given the environment, the asset quality of our commercial book remains solid, with 88% of exposures, excluding small business, either investment grade or collateralized. Our reservable criticized exposure metric continues to be the most heavily impacted by COVID and increased this quarter by $10 billion from Q2. It should be no surprise to you that exposures in the hotel and airline industries led that increase. However, it's also worth noting that our commercial NPLs, which are lower rated than criticized, are still only $2.2 billion, flat compared to Q2, and remained low at only 43 basis points of loans. With respect to commercial real estate, which is an area of focus given COVID's potential impact on the sector, we feel very good about our exposure and reserve coverage. Today, outstanding loans for commercial real estate are $63 billion, which represents 7% of total loans for Bank of America and less than 25% of total equity. These percentages are very low compared to the broader industry. 90% of these loans are either investment grade or secured by collateral. We have a diverse mix of exposure led by office space at about a quarter of CRE, the CRE portfolio, multifamily, retail, hotels, each just north of 10% of our CRE exposure. And our exposure is also regionally diverse, with only one area of the country representing more than 20% of the CRE loan book. Currently, we have a little more than $400 million in this book on NPL status, and year to date, we have seen less than $200 million in net charge-offs, and we hold nearly 3.7% of allowance against these loans. I'll just take a moment to go a little deeper on our exposure to hotels as an example of our measured approach over the years. Within CRE, we have about $7 billion outstanding loans related to hotel properties. That is less than 1% of overall loans. With respect to asset quality of these loans, 85% of them are collateralized, with many having pre-COVID LTVs around 50 to 55% that can weather a meaningful price decline. And while 60% of these loans are classified as reservable criticized, only $120 million are NPLs. Okay, turning to the business segments and starting with consumer banking on slide 14. In the interest of time, I will keep my comments brief on the lines of business and just hit the highlights on the slides we normally provide. In the first half of the year, compared to our other segments, consumer banking was the most heavily impacted by COVID, as it bore the brunt of revenue disruption from lower rates and lower consumer spending, as well as the need for customer assistance. It also bore a large dislocation in credit costs, not because of realized losses, but instead from establishing reserves for losses which are projected to materialize over the coming quarters. In Q3, we did not add reserves, and you can see the improvement in profits versus Q2. I would also note that expected credit losses have yet to materialize. In fact, we saw reserves and net charge-offs decline from Q2. We also saw improvement in consumer fees as activity and account growth improved, and we saw less demand for customer assistance through fee waivers. We also believe this quarter may be the turning point with respect to COVID expense. As COVID costs decline, we expect to see the benefit of a more digitally engaged customer base. We earned $2.1 billion in consumer banking in Q3 versus roughly $100 million in Q2, but remained well below last year's results as NII, fees, and expenses have all been pressured by the pandemic. It is worth pointing out that both our rates paid and cost of deposits declined as deposits grew and we handled more transactions, but were more productive as a result of digital processing. Client momentum in this business continued to show strength around deposits and investment flows, while loan growth continued to be impacted by declines in credit cards. Let's skip to wealth management on slide 17 and 18, and I will refer to both of those pages as I speak. Here again, the impact of lower rates on a larger deposit book resulted in lower NII, impacting an otherwise solid quarter with positive AUM flows market appreciation, and solid deposit and loan growth. Net income of $749 million was down 32% from Q3 19, driven by a decline in revenue as well as higher non-interest expense. Net income improved from Q2 on lower provision expense as reserve building subsided. With respect to revenue, lower NII more than offset improvement in asset management fees. Expenses increased in comparisons against both periods, driven by revenue-related expense and investments in our sales force. Merrill Lynch and the private bank both continued to grow clients as we remained a provider of choice for affluent clients. As a result of the great work of our advisors to provide advice and guidance in these challenging times, year to date, we've added nearly 17,000 net new households in Merrill Lynch and more than 1,400 net new relationships in the private bank. Client balances rose to a record $3.1 trillion, up 6% year over year, driven by the rebound in markets as well as positive client flows. Let's move to our global banking results on slide 19. Global banking results continued to reflect COVID-related impacts of both lower interest rates and higher credit costs in the quarter. Mitigating these impacts, the business continued to produce strong investment banking results. The business earned $926 million in Q3, which included adding $555 million to credit reserves. Net income declined $1.2 billion from Q3 19, split relatively evenly between lower revenue and higher credit costs. The decline in revenue was driven by lower NII as a result of lower rates. Within non-interest income, taxed advances leasing revenue was lower while IB fees rose. As I mentioned, investment banking fees for the company were $1.8 billion, and they were up 15% year over year. An increase in non-interest expense year over year primarily reflected investments in the platform, including our merchant services business. While average deposits are up nicely year over year, average deposit levels declined from Q2 as we continued to lower rates and some customers chose other uses for their liquidity. Rate paid on deposits are now lower than the level seen at the end of 2015, just before rates began to rise. Average loans year over year were modestly lower, reflecting the paydown noted earlier. But it's worth noting that we have seen positive trends on spreads, albeit at lower origination levels. Switching to global markets on slide 22, results reflect solid year-over-year improvement in revenue from sales and trading, but also the expected decline from the robust levels of Q2. In addition, this quarter we saw an increase in both revenue and expense associated with processing an unprecedented level of claims for unemployment insurance. This is another important activity during this pandemic period, whereby we get money in the hands of those who need it on behalf of the states. Unfortunately, the costs, as in many other COVID-driven activities, were quite a bit higher than the fees received. We expect both to reduce substantially next quarter. As I usually do, I will speak about the segment's results excluding DVA. This quarter, net DVA was a loss of $116 million. So global markets produced $945 million of earnings in Q3, modestly higher than Q3 19. Year over year, revenue was up 13% on improved investment banking fees, higher sales and trading, and the fees for processing unemployment claims. The expense increase was driven by higher claims process costs, as well as higher brokerage clearing and execution costs associated with higher activity in Asia. Sales and trading contributed $3.3 billion to revenue, increasing 4% year over year, driven by a 6% improvement in equities and a 3% improvement in FICC. The improvement in FICC results was driven by performance in mortgage and FX, while the strength in equities was driven by client activity in Asia. Finally, on slide 24, we show all other, which reported a profit of $296 million. Compared to Q3 19, the improvement in net income is driven primarily by the prior year $2.1 billion pre-tax impairment charge associated with our merchant servicing JV. Compared to Q2 20, the earnings reflects the $700 million tax adjustment associated with our UK deferred tax asset. The tax expense improvement versus linked quarter was mostly offset by 2Q's $700 million gain from the sale of mortgages and the higher litigation expense in Q3. In Q3, the tax rate reflected the benefit of the tax adjustments as well as the ongoing benefit of tax-advantaged investments. In Q4, absent unusual items, we expect the effective tax rate to be around 10%, reflecting the impact of tax credits relative to pre-tax income. And just a reminder, these tax-advantaged investments, which are driven by our commitment to ESG, also result in pre-tax partnership losses booked in consolidated other income, and these partnership losses are normally seasonally high in Q4. Okay, with that, let's jump to Q&A.
At this time, if you'd like to ask a